traders, welcome back. Michael Harding here from the Academy of Financial Markets. In this lecture I'll explain pips, spreads, and broker commissions. So what exactly is a pip? Well, a pip is made up of 10 points. A pip is made up of 10 points. Okay, so if I just open up a new order, so let me open up Euro USD. So the last decimal place is a point. And so 10 of these points will equal a pip. So if this goes up 10 points, it will change this from 50 to 51. So then that means it went up 1 pip. Okay, if this goes from 1.0650 to 1.06700, then it went up 50 pips. Okay, and 100 pips is equal to 1 cent with US and Canadian dollars. So it's 100 pips is equal to 1 cent. Okay. So the last decimal place with all currency pairs is considered a point, and 10 points equal a pip. So same thing with USD yen. The last decimal place is a point. Okay. Now let's talk about spreads. So a spread is basically the difference between the bid and the ask. So the price on the left side of a currency pair is the bid. So this is the actual price, the real-time price in the market at the moment. The ask is what price the broker raised it to, and this is where the broker makes their commission. So right now, the difference between the bid and the ask is roughly 2.5 pips. Okay, roughly 2.5 pips there. And so that's the broker's commission there. Sometimes brokers also charge another commission for executing, buying in on a position, but most brokers just take their commission through what's called the pip spread. Okay. Now in the next lecture I'll explain trading majors versus minors.